Good afternoon, everybody. Welcome to today's presentation. My name is Allison LaFerlita. I am the Executive Director for the Nonprofit Resource Hub. If you are new to our organization, we are an organization that supports the good work that you do through educational events like this, through advocacy, and additional supports and services. If you are with a nonprofit and you are not yet a nonprofit partner with the Nonprofit Resource Hub, it is free to join. We do encourage you to do so. You will have access to wonderful events like this, in-person events, and a plethora of education and support that we keep on our website and throughout. Today, we will be talking about 10 tips for a best-in-class finance department. This will be presented by Nicole Frisina. She is a manager at Your Part-Time Controller, and she has been working in the nonprofit world for some time now. So I would like to introduce Nicole and welcome her to today's webinar. Nicole, welcome.
Thank you, Allison. Thank you. And thank you, Nonprofit Resource Hub, for having me today. Welcome, everybody. We're going back to school today. Excited to talk to you about 10 tips for a best-in-class finance department. Um, and my screen is not advancing. There it is. Okay. So before we get started with today's content, I would like to just take a moment to talk a little bit about Your Part-Time Controller, also known as YPTC for short. We're a professional services firm. We've been specializing in nonprofit financial management for over 30 years, with the goal of helping our clients sleep better at night. Our services include day-to-day accounting, bookkeeping, financial reporting, data visualization, and implementing best practices, just to name a few. We currently serve over 2,000 clients located throughout the United States. While we have 13 regional offices and continue to grow, we are proud to be able to serve our clients remotely all over the country as well. Let me introduce myself again. So my name is Nicole Frisina. I've been with YPTC for nearly 10 years serving the nonprofit community. I've worked with a variety of industries within the nonprofit sector, arts and culture, museum, schools, name it, and I've probably have seen it at some point in time. So going over our learning objectives for today, we're going to first talk about explaining what makes or who makes a strong finance department team member. We'll talk about understanding the importance of a secure internal control environment when building a strong finance department, describe actions and best practices of an efficient finance department, and then we'll summarize the tips that contribute to a best-in-class finance department. So tip number one, your finance department should serve a dual role. Often accounting is the last thing your organization wants to worry about until management needs a financial report to hand to a donor, creditor, or board member. This shouldn't happen. Your finance department should not only provide financial information, but also serve to educate your board and management on proper accounting procedures. You can build a stronger finance department by implementing the suggestions we review today. I do want to emphasize that building a stronger finance department does not only involve actions of the finance department, but it also includes, the board and the management. They play a role in the process as well, and we'll discuss that a little bit more. So some food for thought. Um, what would you think would, if a nonprofit were awarded funding specifically to create a better finance department, how would you spend it? We'll kind of come back to that in a little bit. So now let's discuss who makes a strong nonprofit finance team member. So first off, the members of the accounting or finance department must have the right education and background, the same as if you were to hire somebody for a program staff. We too often see, however, that management has not taken the time to understand the credentials of the person. For example, they hire a great bookkeeper, but expect that person to do the job of a chief financial officer. If the wrong people are in the accounting department, it heightens the risk significantly and wastes precious resources of the company. Maintaining the education and expertise of the team is also important. Ongoing training is necessary to maintain this knowledge base. For this reason, we also do not recommend using volunteers in the finance department. And anyone working in the background, anyone working in the finance accounting department should have background checks and reference checks performed. Due to the nature of the role, including access to sensitive confidential data and the opportunity to commit fraud, and you want to reduce that risk. So kind of going into what are the expectations with two of the roles that could be fulfill your finance department. Starting with staff accountant, the duties performed could include processing of accounts payable or accounts receivable, payroll, 1099 preparation, which we just completed, back in January, grant monitoring or expense tracking, audit preparation, and special project work like system migrations or detailed account reconciliations, or even just additional support for the controller. On the other hand, the controller should be focusing less on the day-to-day or the transactional duties and more on the reporting and the analysis, such as closing the books, preparing basic financial statements, variance analysis, board presentations, or leading the audit process, the budget process, cash forecasting. When filling open positions, management may consider employing the services to help them hire for finance positions. These professionals can help nonprofits identify the necessary skill sets for their positions, provide interim solutions, and especially lower the amount of worry management. And the board may have surrounding financial management. Outsourcing is of particular benefit to a smaller nonprofit that may not have the budget for a full-time controller. So tip number 3, we want to make sure we're prompting a secure internal control environment that is ingrained in the culture, setting the proper tone from the top, establishing and enforcing policies and procedures and segregation of financial duties. Let's look at each of these in a little more detail. The tone at the top refers to the ethical environment within an organization and how it cascades down through the organization. It can be good or it can not be good depending on the circumstances. Setting the proper tone at the top starts with the board, the executive director, and management to exemplify ethical behavior, ensure that effective policies are implemented and followed through the organization. It's the board's responsibility to exemplify ethical behavior. Board members must be beyond reproach in their words and actions as it relates to governance and financial management. You must act in the way that you want management and staff of the organization to act because you are setting the example for everyone to follow. Board members and management should also take care to protect the assets of the organization. You should be thinking about things that could go wrong. That is, risky situations for both the physical assets of the organization or the organization's reputation, and ensuring that the internal controls of the organization are set up to mitigate these risks. Having a risk management mindset is very important, especially as a board member. But there is a balance. Being too conservative as it relates to risk can sometimes stymie innovation and operations. We accountants like to use the term healthy skepticism as it relates to striking the right balance relating to management of risk at organizations. A good way that you can help ensure that your organization's assets and reputation are protected is to ensure that there are proper financial policies in place and they are being followed by all who have fiscal responsibility. I'll share a few policy musts shortly. Additionally, the board needs to ensure the right people are in place on the board, similar to management, and have financial management knowledge. Not all board members nor executive directors will have formal training in nonprofit accounting or financial management. Of course, that's fine, but not having this knowledge should not be used as an excuse to let the financial management of the organization rest solely on the shoulders of the finance department. It is the responsibility of the board and management to be educated about financial topics important to running their organization. Sessions like this one are a good place to start, but going further, the board and management can also take a course in nonprofit financial management. Look for sessions that go into a deeper dive of understanding the financials of nonprofit organizations. Ask the finance department members to provide education. This is where YPTC really shines with our clients. Every month, we meet with the executive director and often the board to review the financials at first, to review the financials. At first, they may be resistant, but over time, the EDs really start to understand and then can use the monthly financials in their decision making. And then having the finance team come to the board meetings is often very helpful, whether it's a routine presentation of the financials or a special topic that the board would like to explore. And lastly, don't be afraid to ask questions. Board members need to know what's going on. So if you don't say something or if you don't understand, then speak up. And most likely you're not the only one thinking about it. Board members should not be afraid to ask the executive director and the accounting department about anything. Finance team members should expect these questions and be prepared to provide answers. That is, anticipate the questions that may be asked by the board or the executive director. For example, in reviewing the balance sheet, the biggest thing that a board should ask is, does the organization have enough cash to meet the organization's short-term or long-term needs? When it comes to policies and procedures, we need to make sure we're not just setting the tone, but also enforcing them. Setting policies for cash disbursements is key. The executive director or the CFO shouldn't be approving their own expense reimbursements, nor should this be done by someone on staff. It should be done by a board member because that provides that additional level of oversight on the executive director and the CFO. Daily review of the bank activity is necessary to ensure no inappropriate or fraudulent transactions occur. Additionally, the finance leader shouldn't be the only one that sees the bank reconciliations or the payroll reports. Review and approval of these reports by the executive director will ensure they stay informed about basic financial activities that have a significant impact on the finances of the organization. Most transactions begin or end with an entry to cash, and the most significant expense for most nonprofits is payroll. If possible, avoid company credit cards and never use debit cards. Not using credit cards or at least significantly decreasing the usage may be a large cultural change if the organization relies heavily on them. But they can be super difficult to manage and are easily abused. I've seen it too many times. At the very least, utilize a credit card management system such as Divvy, also known as Bill Spend and Expense, that have low limits. You can set low limits, and you can also help to build up strong policies around the usage. And segregation of duties is still key to a sound internal control environment. The key lies in limiting individual control over those finance functions in such a way that no one person has complete control over a transaction from beginning to end. In this chart, we've identified typical finance-related tasks. We have it in these three buckets: accounting, other staff, and management. And this is how they could be dispersed throughout the organization to help create appropriate segregation of duties. To give an example, the person inputting the bills, preparing the checks or the ACHs for bill payment, and those signing the checks or approving the electronic payments should not all be the same person. And yes, if your entity utilizes an electronic bill pay solution like Bill.com, that's the same thing as signing a check. You should still have those same sort of controls that you have different people handling each one of these responsibilities. It's often difficult to have this sort of segregation of duties in smaller organizations, but it is possible with the involvement from the executive director or board members like the board treasurer or others outside of finance performing some limited functions. For example, requiring bank reconciliation and statement review by the executive director or another person independent of the process. Or consider having the board treasurer review and approve the expense reimbursements submitted by the executive director. Another solution is to bring in an outside consultant to perform some of the finance functions. Not only is this a great way to enhance your internal controls, but it also provides affordable access to nonprofit expertise. As a second example, the person who processes the payroll, the person who approves the payroll, and the person who reviews the payroll should also not all be the same person. Often the reviewer and the approver are the same, and many times that's the executive director. In those situations, it's important to have an additional level of review of salary adjustments included in payroll. So this brings us here to poll question number 1. I'll give it a minute. It should be popping up on your screen. But in general, how do you feel? What is the number one way to catch fraud at any organization? Do you think it is about hiring the right people? Do you think it's about activating two-factor authentication for all online accounts? Implement a remote deposit solution? Perform monthly bank reconciliations? Or none of the above? Great. So we have about a little bit of a split between hiring the right people and activating the two-factor authentication, but 64% said performing monthly bank reconciliations, and that is correct. While all of these are good ways to reduce fraud, the only way you'll actually catch it is by performing those monthly bank recs. And this brings us to tip number 4, performing those monthly bank recs, right? So cash is king. Reconciliations must be done timely and accurately. Timely, in my opinion, a bank rec should be done within, I would say, 2 to 3 business days of the month end. And included in that, you're reconciling all the items and investigating or correcting anything as necessary. Note that the reviewing of the daily bank activity does not take place of performing the monthly bank reconciliation. And let's talk through some other do's and don'ts regarding these. So do perform the bank reconciliation within your accounting system like QuickBooks. If there's one thing we hope you take away from today's session, it's the importance of performing the bank recs every single month using your accounting information system and not Excel. I'm a big fan of Excel, but if I see bank recs being done in Excel, I just know that it is very high, like definitely at a higher risk of errors. Performing the recs, may result in, performing the recs in Excel may result in missing activity that is in your accounting system, or formula or tying errors that compromise the reconciliation. Do perform cash and investment account reconciliations every single month, and include in this online platforms like PayPal or Stripe in these reconciliations. With PayPal, it's almost like another bank account. The money will sit in there. So your organization should have a policy of transferring the funds from that online platform to your operating account once they reach a certain threshold. If you aren't seeing these deposits or transfers occurring, that's an indication that no one is monitoring these accounts. Do have someone outside the finance department review. We mentioned that before. You can have the executive director review the bank reconciliations. You can even have the board treasurer. But it's good to have somebody outside, and that helps provide that level of healthy skepticism that we spoke about earlier. Do use banks' deposit pay that is available in most national banks. This will match the ACH and checks issued with those that are presented for payment. It helps reduce the risk of fraud. If your bank does not offer positive pay, it may be worth considering finding one that does. Fraud is always a concern for all nonprofits, and it only continues to get worse. So this is really a great way to help mitigate that. And then always call to confirm online bank transfer requests. This is another tip here because this too, fraud is so prevalent now. And it's very easy to get an email from somebody who is of a higher management, executive management saying, you need to transfer this money now. Um, it's really important that you and your staff know to pick up the phone and call, whether it's the executive director or whomever gave that order, to ensure that this is actually something that needs to happen. Or also, if it's coming from a vendor, call the vendor number that you have on file. Don't use the number that's in the email. That too just help reduce that risk of fraud. Now, from a don't point of view, we mentioned this before, don't be performing those bank recs in Excel. Don't ignore things like uncashed or stale checks that are over 90 days old. If you're seeing these on your bank reconciliation, you should be asking, has anybody contacted that vendor to try to reissue payment? Why hasn't why hasn't the check cleared? Um, and if the check hasn't cleared, is there some other, is there a reason for that? And also kind of pay close attention to those small deposits, like a couple of pennies or even a couple of dollars. That could indicate possible fraud attempts. It's not always the case, but again, it's worth having that healthy skepticism. Don't prepare financial reports until the bank recs are done first. The one thing, anytime we go into a new client, the first thing we want to make sure is that bank recs have been done. Because again, if you know bank recs are done, your cash should be relatively good, and then at least your revenue and expenses should be relatively in a place, not maybe perfect. But we shouldn't be preparing financial reports unless bank recs are completed. Don't forget to shut down online access if and when there's a change to an authorized check signer. That again just helps reduce that risk of fraud. And never process an ACH request that originates from an email, again, without calling that vendor or the requester to confirm it and speaking to them and being smart about where you're getting that phone number from and not just using the one in the email. Tip number 5, educate the board on fiduciary responsibilities and management on compliance responsibilities. Board members have 3 fundamental areas of legal and fiduciary responsibilities. First is the duty of care. This requires that a board member participate actively in governance and oversight of the organization's activities. This includes attending board and committee meetings, reviewing and understanding the organization's financial documents, helping to frame strategic plans, identifying and managing risks as well as opportunities, and taking prudent steps to advance the organization's missions and goals. Most importantly, the board members must show up for the meetings. Next is the duty of loyalty. This requires that a board member act in the best interest of the organization at all times. In areas of potential conflict, they must put the needs of the organization above themselves. This includes identifying and disclosing potential conflicts of interests before joining the board and whenever they may arise. And then finally, the duty of obedience. This requires that a board member works to ensure that the organization complies with applicable laws and regulations, acts in accordance with its own policies, and carries out its mission appropriately. And now for the financial responsibilities. Each organization should have a board committee dedicated to financial management. Best practice is to have separate committees for each. However, in reality, especially with smaller organizations, often there is one committee that covers the 3 sets of responsibilities. The first is the role of the finance committee. This is primarily to provide financial oversight for the organization. Typical task areas include reviewing the monthly financial reports, budgeting and financial planning, and the creation and monitoring of internal controls and accounting policies. Next is an audit committee. This is either a task force or a standing committee that has been given the authority by the board of directors to provide accountability for the company's independent audit. The audit committee, not management, should select the auditors, monitor the activities of the auditors, and review the audit before it's presented to the board. When I have been involved in the process for picking a new auditor, I always make sure that either the board treasurer or some sort of board member is involved in the process. I also make sure that when we get references for the different audit firms, that it's the board member calling those references and discussing with them. This is part of those financial responsibilities that we're talking about. The responsibilities of the investment committee include creating and monitoring investment policy, ensuring the right investment managers are in place, and monitoring investment returns. The overarching responsibilities in these committees are to closely monitor all aspects of the financial situation of the organization and report back to the board. Very importantly, though, this does not absolve other board members from their fiduciary or stewardship responsibilities. These members who are overseeing these committees, they're just helping to report back. If you're the treasurer of a board, you should be clear with the board about the financial situation so they understand and share in the responsibility of solving problems. As an example, if the nonprofit is weighing the option of accepting funding that will add positions or create other permanent infrastructure changes in the organization, it is important to know whether the funding renewal options or if the organization will have to provide the funding or changes beyond the first year. Talking a little bit more about management compliance, ensuring that management is aware and compliant with all applicable regulations, contract provisions, and internal requirements will make finance's job much easier in the long run. Providing education on these key components will enable management to become a partner in their compliance. Just to point out a couple of compliance areas included in the chart here, if your organization receives an award of federal funds, either directly from a federal agency or a pass-through from a state, city, or another nonprofit, your organization may be subject to uniform guidance rules, which is also known as a single audit. Currently, the threshold has just been increased to $1 million, but it's still a possibility. There are specific compliance tests that the auditor will perform with these single audits. And some of them are program specific and not necessarily related to finance. So it's important that management understands what's required. There could be ad hoc and like state and local registrations that are needed as well. As an example, in the state of Pennsylvania, they require a separate game of chance license if you want to have a raffle or a 50-50 drawing. And while nonprofits are generally exempt from paying sales tax on certain purchases, they are not exempt from collecting and remitting sales tax on the taxable goods that they're selling. It's important to remember that hiring a best-in-class finance department will not absolve management and the board from their fiduciary and compliance responsibilities, but it will make their roles much easier. On the flip side, when management and the board understand and take ownership of their fiduciary and compliance responsibilities, the job for the finance department becomes easier as well. And this brings us to poll question number 2. This will pop up on your screens in a second. True or false? A board member can be held personally liable for unpaid federal payroll taxes. So do you think this is true? Do you think it's maybe, but professional liability insurance will cover it, right? Or is it false? Okay. So 64% said true and 18% between maybe and false. So yes, the IRS can hold board members personally liable for unlawful acts committed while in office, such as willful failure to collect or pay over federal employment taxes like payroll taxes, and certain types of excise taxes, such as those imposed on various goods, services, and activities. Directors and officers insurance, also known as D&O insurance, also known as professional liability insurance, will not protect board members from willful failure to collect or turn over these taxes. This brings us to our next tip, number 6. Timely remittance of your payroll, tax, and employee benefits. Yes, nonprofit board members can be held personally liable for non-remittance of payroll taxes. This is a compliance function. Employee withholdings are required to be remitted as soon as reasonably possible. This is within 1 or 2 days after payroll completion is appropriate. If you see payroll liabilities, such as payroll tax or employee withholdings sitting on your balance sheet and they're increasing each month, then there's two possibilities that could be happening here. The first is maybe the remittance is not occurring immediately after each withholding, or the finance department is not reconciling that account properly as part of their monthly close. So again, it's really important that we're also paying close attention to these balances. I also want to note how important it is to remit employee benefit withholdings. If your organization is offering 401k to their employees, then you must remit the withholdings. So these are the dollars that the employees are putting to the side for their retirement within 1 to 2 days after collection. In my prior life, I did perform some employee benefit audits, and it doesn't matter the size. It's extremely important to ensure that these remittances are occurring. If they're not happening, then you may incur significant penalties or end interest on that. Tip number 7, ensure that the entity's accounting staff understands and follows generally accepted accounting principles or GAAP. These are two issues. There are two issues with GAAP that we encounter quite frequently, and I want to talk through those. So there are 3 general methods of accounting for transactions in an organization. First is cash basis. This is very simple. It's basically the revenue is recorded when the cash is received or that check comes in the mail or hits the bank account, and the expenses are recorded when the cash is paid and that's going out of your bank account. There is a modified cash or modified accrual basis. This is a hybrid methodology where some transactions are recorded on the accrual basis while others are recorded on the cash basis. And then accrual basis. This is when revenue is recorded when earned, not when it's received. So using that cash, it's not necessarily when the cash came into the bank. It could be when the grant was received. And expenses are recorded when they're incurred, not when they're paid. We encourage our clients to use accrual basis of accounting. Why? Because accrual basis helps generate those assets and liabilities that you would see on the balance sheet or the statement of financial position. These receivables and payables are integral in cash planning and forecasting purposes. Accounts receivable, these are the amounts that the customers owe you or like your donors owe you. And accounts payable are what's owed to your vendors. For simplicity, smaller organizations, particularly if they are not required to conduct a financial statement audit, may choose cash basis over accrual. However, doing so makes cash forecasting impossible. The second area of focus is on revenue recognition. So accounting for contributions, it can be complicated. We have a whole course within YPTC on just how to account for contributions. But contributions are voluntary, non-reciprocal gifts, meaning that a donor does not expect anything in return. As many of you know, contributions can take many forms. They can be financial, gifts of cash, pledges to give cash in the future, or they can be non-financial, gifts of land, buildings, use of facilities, materials and supplies, or even use of services, right? To further complicate matters, GAAP requires different types of contributions to be recorded differently. So your finance department must have the expertise to distinguish between the various contribution types and the guidance that governs them. Restrictions and conditions placed by the donor impact the timing and the amounts that can be recorded and available for use by your nonprofit. So donor imposed restrictions, these place responsibility on management to use the assets, to contributed assets as stipulated. These restrictions may be temporary or permanent in nature, and they can be explicitly stated or implied by the circumstances. So going with donor imposed restrictions that are temporary in nature, these could include gifts restricted for a specific program. So I'm giving you money to provide meals to within your shelter. It could even be to acquire a building or equipment. Gifts can also be used after a specified date. So, such as you get like a 3-year grant that is a certain amount of money each year. Donor imposed restrictions that are permanent in nature. These are endowment funds, permanent endowment funds, also perpetual trusts. These are trusts that are held by a third party where the nonprofit has the right to receive income earned on the trust in perpetuity, but never receives the assets held in the trust. The implicit restriction example, that can include like contributions to a capital campaign whose stated objective is to raise funds to purchase a new building. So even though maybe the donor is not implying, but if they're donating to that capital campaign, um, if the donor is not explicitly stating it in their donation, but they're contributing to that capital campaign, then it's being implied. Now, there's also conditional grants. So a donor imposed condition. These are like those that are required. These are similar to those that require like a matching pledge. They may limit the funds available that are the availability even further. This is because they cannot be recorded until the donor imposed conditions are overcome. Another example is that matching pledge or a challenge grant or awards based on achieving a series of milestones. Going back to the example, if let's say the requirement is that you have to provide 5,000 meals, to homebound senior citizens every quarter, because you're indicating the number of meals that need to be provided, that condition needs to be met first before we can recognize the revenue. Keep in mind, though, accounting rules change as everything else does, right? You need to have a knowledgeable person in your finance department to keep up with and understand the changes and implement them as necessary. Tip number 8, conducting a financial statement audit, whether your organization is required to have one or not. So why? An audit increases the value and credibility of the financial statements produced by management, thus increasing user confidence in the financial statement. This could translate into increased contributions or grants. Recent changes in audit guidance that we may want to share, right? So in audit reports, the audit opinion will now appear first. There are enhanced communications detailing auditor and management responsibilities. Thus, your auditors may ask more questions than you're used to. One question that will sure to be come up is whether management has performed a going concern assessment. The auditor is required to read and consider other information, financial or non-financial, like board minutes, even the entity's annual reports. If the report is available, the annual report is available before the audit is published. Thus, your entity should not be surprised if the auditor asks to see that as part of their prepared by client list that they give you. Tip number 9, finance calendar. This identifies all items that impact the finance function. It's really important. The keyword there is function during the year. So there's a certain commercial out there, right? That says, "What's in your wallet?" Well, that's what you should be having in your finance calendar. We've broken this out into a few different buckets of information to consider. Um, you have meeting dates. So you can indicate when are board meetings, when are the finance committee meetings happening throughout the year? When is the budget review? Think about your fiscal events, such as how often is payroll being run? Is it biweekly? Is it the 15th and 30th of each month? Is it weekly? When is the month-end close occurring? When are the bank and credit card recs being done? When are the financial reports due so that they can be processed in preparation for those board meetings and finance committee meetings? And then other regulatory requirements. When is that payroll and 401k remittance happening? The Form W-2 or 1099s, or the company's W-9. This is if you were, from the from the other side, like if you need to get a 1099. When is a 990 due? When is the annual audit happening? And then other deadlines to consider: your insurance and medical plan renewals, your business liability insurance renewals, charitable registration in certain states that has to be renewed every year, even your GuideStar profile. These should all be items that we should have on our finance calendar. It's useful to have these deadlines planned and met throughout the year. And it can also be it's also important to share this with other members in the organization. This, even though its title is a finance calendar, you should include everybody in there, especially development. When are the grant reports due? Because that will help finance to be understand what are the timelines that development needs to meet so that they can meet their needs. But it's really important that everybody is sharing in this, and that's where that function that I mentioned before. Here's an example of one. So this is done in Excel. It may not have to be actually on a calendar. It could just be a checklist type approach. So you can see everything in chronological order as you're planning out your work. You could do it in Excel. You could do it in Google Sheets. I've had clients do it as a separate calendar in Outlook or Gmail. I've even seen other clients use like one of those like workflow management tools like Asana. Think about the culture of your organization and how this is natural for you to share this type of information. The best tool is a tool that you will actually use. And finally, our last tip is providing timely and accurate monthly financial reports. So financial reporting, the baseline of your financial reports should include at a minimum the balance sheet, also known as your statement of financial position, the income statement, also known as your statement of activity, a cash flow statement, and a variance analysis report that might include comparisons to budget, comparisons to the prior years. But also the reports could include a memo or a summary. This will help translate and explain the financials to the executive director and the board. And remembering that the board in the ED may not have that finance background, but this memo will be important to tell the financial story of the organization in a way that is easy for them to understand. Other reports that could be included in addition to the baseline can be department specific, programmatic specific. You can even consider doing like accounts receivable detail, accounts payable detail, and then also forecasts, monthly statements, forecasts of like income and expense and cash. Forecasts are so important, especially now with everything that is going on. A forecast is really important to see what is your organization looking like for the rest of the year. Where are those ebbs and flows in revenue and expenses? Is there any periods of time where you think there will be a cash shortage? Do you have enough to cover those periods of time? These statements should be completed within 2 to 3 weeks after the month end. This ensures that the information is timely and it's actionable. Any later, and the information becomes stale and then less useful for decision making. This brings us to our final poll question. And this kind of reflects back on the first one I mentioned earlier. If your nonprofit were awarded funding to create a better finance department, how would you spend it? And you can select all that apply in your case. Would you hire finance department staff, invest in better internal controls, provide board education, staff education on nonprofit reporting issues, or conducting a financial statement audit, and finally, assisting preparing the monthly financial report? Okay. Oh, wow, it's a nice little bit even throughout. So number one is staff education on nonprofit reporting issues. I think that's great. The second one here, it's actually a tie between board education and assistance in preparing the monthly financial reports. I also think that's extremely important. And then it's kind of close between the hiring the finance department, investing in better internal controls, and conducting that financial statement audit. All great things. So let's just kind of do a quick recap of all of the 10 tips we spoke about this afternoon. Tip number one, building that strong finance department. Just remember, the finance department should serve that dual role of providing the financial information, but also educating the management and board on the proper accounting procedures. Number two, ensuring that you're hiring the right people. Those in the finance department should have accounting knowledge. They should know what a debit and credit is. They should know how to prepare a balance sheet and an income statement. Promoting the secure internal control environment. So it's not just a matter of putting policies and procedures in place of internal controls, but also implementing those and enforcing those policies. And don't forget to think about the segregation of duties, which is extremely important. Ensuring that that same person is not performing all of the duties from beginning to end, like we gave the example with accounts payable. Um, tip number four, performing monthly bank reconciliations. These must be performed monthly, and as I mentioned, they should be completed within the first 3 business days of the month. Number five, educating the board on fiduciary responsibilities and management on their compliance responsibilities. Number six, timely remittance of that payroll tax and employee benefits. Remember, the board can be held liable if these are not being remitted. And number seven, following generally accepted accounting principles. Our recommendation is to prepare your books on an accrual basis. This will allow for better planning with those forecasts that we mentioned before. Number eight, consider doing that financial statement audit. There is a threshold that if your revenue's over $1 million, then you're required to do an audit, but it's still a great opportunity to do it, even if you're under that threshold. Some donors require it, and so it just only helps you in the long run. Number nine, where's me? Number nine, utilizing that finance calendar. It details when things happen, and it's not just about finance. It helps keeps everybody involved accountable. Our program people, do they have to hand in anything so that finance can record it in order to ensure that everything is being done timely and accurately? So this is shared with everybody, and it's not just about the finance department. And then number 10, providing those timely and accurate monthly financials. So having that finance calendar will help set the sort of like the timeline of things, and that'll allow you to keep it as on a timely basis. Remember, with timely, it should be done within 2 to 3 weeks after the month end close. And accurate is performing a monthly close each month with your balance sheet accounts, ensuring on that accrual basis that you're recording for prepaids and accounts receivable and accounts payable and deferred revenue. Making sure that it's being discussed with each individual department to ensure that everything is being recorded properly. And also with number 10, don't forget your baseline of reports, the statement of financial position, statement of activity, a cash flow, or a rolling cash forecast, like dashboards or KPIs, like key performance indicators. How much cash do you have available? And a variance analysis as well, and different levels of reports for each of the different groups. I really enjoyed our time today. I want to see if there's any questions in the chat. I have not been fully monitoring it. So I see somebody said, can you share a closing schedule that can be tweeted? So we have one in the slides here, and I know the slides will be shared afterwards, so you can use that as the example of some of the ideas to consider for your closing schedule for the finance calendar. For a monthly close schedule, some ideas I can give you are going back to those bank recs, making sure those are being done, but it's really going down that balance sheet in each of your balance sheet items and doing an analysis on each of them, looking at your prepaids each month, looking at if you have fixed assets, are you depreciating the assets each month? Looking at the liabilities, especially like if you're remitting payroll taxes and you're not using a company like ADP or paychecks, and it's something that's sort of being done internally, ensuring those are being done timely. Looking at accounts payable. And then also included in that, I would do a revenue reconciliation between what's recorded in your general ledger accounting system and then what's recorded in your donor database system. Those are all really great things to be doing on like a monthly close basis.
Nicole, I have some questions here that were emailed to me, if
Yeah,
I may.
absolutely.
So, the first one is, hang on, I'm sorry, I just had it. In your opinion, what are the most common internal control weaknesses in nonprofit finance departments?
Oh, that's a great question. Number one is segregation of duties. I often see that you have the same person who is inputting invoices and approving the invoices. So often it is, the person entering the invoices, like they get it from the vendor, they put it in the system, and then they're the one approving it, and then they may be sending a list to the ED to review it before it gets paid. But often I see that a lot. Um, Another internal control weakness I see is, and I don't know if this is necessarily internal control, but it's something I see often too, is that development, um, and it maybe not just development, but it's that not grant, like whatever grants might be coming in aren't being shared with the finance department. So often the finance department will, produce their financials and then development will look at the revenue and they'll say, oh, well, this grant came in, why is that not recorded? And this grant came in, why don't I see that there? Or cash came in against this, but it hasn't been offset against a receivable. So it's not necessarily internal control, but I do often see that a lot too, that there's just a lack of communication and clarity within each department.
Excellent, thank you. Are you ready for another one?
I'm ready. Give it to me.
Um, is there an accounting software that you would recommend for small to mid-sized nonprofits?
Yeah, QuickBooks is the best. If you are a 501(c)(3) registered, you can go on TechSoup and you could purchase QuickBooks for a very reasonable price. And I don't know the numbers off the top of my head, but TechSoup is like it's also like a nonprofit based website. You have to first apply to get in, and basically you have to show that you're a 501(c)(3). And once you get it, then you can purchase things at a discounted rate, and QuickBooks is one of them. But I do find that to be the easiest. Um, you can do some really great things with QuickBooks. You can segregate between what is administrative, what is fundraising, and what is programmatic, and which is you're going to have to do for your 990 anyway. Um, and you can do invoicing through there. I definitely do see that as the best. And I will say with our clients, 75% of them are on QuickBooks. Once you get more sophisticated, and it also depends, it's not just about revenue size, depends on the complexity of the organization. You could still be small, but quite complex, right? You can have multiple programs that you're involved in or multiple grant reports that you have to do that are very specific, like especially those federal funding grants that we're talking about. Maybe QuickBooks may not be the best option, and that's where you can look at something else. I'm trying to think. Um, Intact is expensive, but it works very well. I have seen some clients use something like FundEZ. Um, NetSuite is another one. Financial Edge is another one. But again, 75% of our clients are on QuickBooks Online.
Yeah, that seems like the gold standard.
It is, yeah.
So I have two more questions for you.
Sure.
Okay, so the first one, this is an interesting one. How do you balance efficiency with compliance when dealing with complex grant reporting?
Yeah. Um, it's all
Do we need
about,
another hour?
yeah, I know, easily. Um, I will say it is about how you're processing it. Um, it all comes down to processes. So, we do say like QuickBooks is the gold standard, but if you're still writing physical checks, get on something like Bill.com. That's also very reasonably priced because what's nice is with Bill.com is you can put in like your allocation methodology in there. So like if a invoice payment comes through that needs to get applied to a certain grant, you could tag that within Bill and that can sync to QuickBooks. You could sync your banking activity. So it's all about trying to build up your processes and utilizing, getting into that 21st century. We still have clients who are on QuickBooks Desktop, and I know it's like scary to go to online, but QuickBooks Online has really sort of blossomed, and is really a great tool. But it's really about the processes that you have in place to help then the reporting you're getting out of QuickBooks or whatever your general ledger system is. There's not this manipulation that's happening on the back end. You're not trying to do these allocations separately. It's all being done within your system. This way, then all you have to do is print a few reports and then fill in the information for the grantor that's required. But it
Okay, and
takes
if
time to
anybody
get there.
wants to have a more detailed discussion with Nicole regarding that, I would
Yes.
definitely suggest giving her a buzz.
Yeah.
We have 2 more minutes, so I'm just going to quickly ask you this last question, which is actually a resource question, which is good for you.
Mhm.
Does YPTC have templates or checklists for nonprofits that can be accessed through your website for best practices?
Absolutely. Please go to our website. We have an area for resources. There's webinars, there's materials on there. There's a wealth of information. If there's anything you can't find, certainly please do reach out to me. I'd be happy to help. You can find me on LinkedIn, but I would also be happy to help.
Okay, here I am.
All
Hello,
right.
everybody. So, Nicole, thank you very
Yeah.
much. That was very action-packed and information-packed. And I hope you're able to see the comments on the side. It's so to give you some feedback, which is all very positive. I do want to thank you for your time. And I
Yeah.
do want to encourage our participants to please reach out directly to Nicole. Like I said, there was a lot going on today. And depending on the size of your organization and the challenges you may be up against, it may be best for you to schedule a consultation with her and have her help answer some of your questions.
Absolutely.
Nicole, do you have anything that you'd like to say in closing?
No, thank you for the time, Allison, and Nonprofit Resource Hub for having me today. I'm happy to do this. And yeah, happy to help too. Please do reach out. The number one thing we want to do is help nonprofits in as much as possible. So happy to
Especially now.
especially now. This is when we need
Especially
it.
now.
Yep.
Yes.
This is
So
when we
thank you all. Nicole's information is in the chat. You are always welcome to reach out to us. Again, if you haven't joined in your nonprofit, please join the hub and you will have access to really amazing resources just like today's webinar. Thanks
Yeah.
again, Nicole, and thank you,
You're welcome.
everybody. Have a
Thank
great
you.
afternoon.
Bye, everybody.